As a Tesla investor, have you ever wondered what the actual value of Tesla shares are? Over the years, several analysts have given their estimates on how much the company's share may actually be worth. But these predictions are subject to numerous factors, especially the volatility of the stock market. However, if you're looking to know just how much Tesla stock is really worth, here is a price estimate you don't want to miss. Hey everyone, and welcome back to Tesla Tomorrow. According to a recent report by financial services company Halter Ferguson, Tesla is one of the fastest growing large manufacturers in human history. The firm believes in a base case scenario, which represents its best estimate at the financial results that Tesla is likely to achieve. The investment firm also stated that while it estimates Tesla stock will remain intact, there is room for Tesla to miss both higher and lower the predicted figures, and it does not believe the stock market to suddenly agree with these predictions. What are these price predictions for Tesla? Let's find out. But before we do, if you like this type of content, don't forget to hit that like button, subscribe, and turn on notifications to keep up to date on everything going on with Tesla. Halter Ferguson's prediction represents a base case valuation ranging from $305 to $383. Adding that this is what it believes Tesla stock is worth today, counting automotive, FSD, energy storage. It, however, noted that this scenario leaves out upside optionality from the new products it has on the line, which could drastically alter the share price of Tesla. According to the reports, Tesla's full self-driving software has been developed with the goal of enabling true autonomy, which would drastically alter the economic value of Tesla's vehicles. It also noted that Tesla's humanoid robot named Optimus, which is currently in its early stages of development, could also drastically increase the utility offered to its customers. Additionally, robotaxis could free up time for commuters, while the bot's total addressable market is the entirety of the worldwide labor market. Halter Ferguson's report also cited that in a scenario in which Tesla truly solves autonomy, it believes the automaker could price the software at around $50,000 while effectively achieving a 100% take rate on FSD. It further cited that while it would increase the total average selling price of the vehicle to levels that may appear unachievable at first glance, these vehicles would have a drastically higher utilization than personal car ownership, effectively lowering the cost per mile driven. Therefore, by making these changes to the base case previously outlined for the year 2030, this results in a present valuation of $1,184 per share for Tesla stock. According to the firm, this $1,184 share value excludes the potential of Tesla to earn recurring revenue as part of its network. It added that aside Optimus and the robotaxis, which are the most significant potential value drivers, there are other factors that could provide incremental value that is not captured in any of this price scenario. And Tesla has teased many of these products, including home HVAC systems, new vehicle types, and large-scale virtual power plants. It cited that while Tesla has historically been viewed as an automotive manufacturer, the company has a long history in the energy sector, and this part of the business is generally overlooked by most analysts and investors because the revenues and margins have been small when compared to Tesla's car business. The report stated that since its founding in 2006, SolarCity has provided solar panel installation services for homeowners, and today, Tesla Energy is responsible for the development and production of Tesla's battery energy storage systems, including the Powerwall and Megapack. It therefore estimates that storage revenues are roughly 10 times larger than those of the solar business, and likewise, the margins are likely much higher on storage than on solar. Addressing Tesla's automotive business, the report cited Tesla's stated goal of 50% annual volume growth, leading to 20 million units sold by 2030. The firm assumes that Tesla would reach 4 million vehicles in 2025 and 12 million by 2030. It also believes that Tesla's manufacturing margins will decline modestly from the 2022 levels. This decline is a product of the recent price cuts and continued price decreases over time. The report cited that Tesla is significantly broadening its total addressable market with new models, adding that further scaling of the Model Y and other new models such as the Cybertruck will give the company access to continued strong growth throughout the decade. According to Halter Ferguson, the rate of improvement in Tesla's FSD software is likely to accelerate, creating a significant value proposition to drivers even as an advanced driver assistance system rather than a full autonomy application. It assumes that the take rate for this software will increase to 20% in 2025 and 30% in 2030. It also estimates FSD revenues to be $16 billion in 2025 and $90 billion in 2030. About Tesla's energy business, the report noted that Megapack deployments are likely to be a significant driver of growth and profitability for Tesla. And in addition to Megapack, Tesla will continue to grow its Powerwall products. The firm also believes that Tesla's solar roof will continue to ramp, although the impact of Tesla Solar is likely to be rounding error compared to its energy storage assumptions. It had cited Tesla's plan to reach 3 TWh of battery capacity by 2030, with at least 1 TWh being devoted to energy storage applications, stating that it is unlikely that Tesla will reach this target, as lithium mining capacity is a significant bottleneck. Its projection therefore assumes that Tesla uses 1.5 TWh of battery capacity by 2030, and this number of batteries would need a lot of lithium. It stated that Tesla was initially battery cell starved, and automotive applications were given priority over the company's energy business. The report further stated that the lumpiness of battery supply translated directly into the lumpiness of energy revenues, which caused many to believe Tesla Energy did not contribute to the valuation of Tesla. It also cited that the lack of consistent supply or a dedicated manufacturing facility meant that margins were far from optimal. Halter Ferguson noted that for the first time in its history, Tesla is no longer constrained by access to battery cells, adding that the company's Megapack manufacturing process is ramping up with a dedicated facility in Lathrop, California, which is capable of manufacturing 40 GWh of Megapacks per year once production hits capacity. While addressing Tesla's services margin potential, it noted that the dollar value of services and software will be smaller than hardware sales, even though they provide a key role in helping customers to realize the objectives of their investment in a battery system. On hardware margin, it stated that gross margins on the Tesla energy business have historically been negligible, leading many analysts to ignore the potential of this part of the business. The report focused on earnings before interest, taxes, depreciation, and amortization, as well as net margins. The firm also believed that the pricing and margin dynamics are likely to change significantly over the course of this decade, leading to energy EBI TDA margins peaking at around 40% in 2025. It noted that just as scaling up Tesla's automotive volumes by 50% per year requires selling price decreases to sustain the total addressable market, the energy business will similarly need to reduce pricing to reach Tesla's TWH scale ambitions. It therefore assumed pricing for storage products will decrease by 8% per year after 2023, reaching $270 per kWh by 2030. It further cited the $35 per kWh credit at the cell level, stating that these credits from these cells alone will be worth $4.5 billion annually once Tesla reaches 100 GWh of scale, and there is little reason to believe Tesla will stop ramping domestically once the facility is built out. While citing Tesla's demand outlook, the firm stated that Tesla is not alone in thinking the energy storage market is poised to undergo explosive growth. It further stated that it believes industry watchers will continue to raise forecasts for future demand, and the ultimate winners will be those who can quickly ramp up capacity. On the other hand, the report noted that there are significant risks associated with Tesla's aggressive ramp, and it is possible that the automaker will not scale to the levels that it has assumed in its base case. It added that if Tesla's energy storage deployments only reach 300 GWh by 2030, and car sales only reach 8 million units with no increase in FSD take rate or price, it predicts a share value of $159. It added that this figure could potentially be even lower if the margin assumptions are revised downward. However, overall, Halter Ferguson expects that Tesla will continue to provide energy management software and services to help customers optimize the performance of their solar and energy storage systems. The firm disclosed that as it gained more confidence around Tesla's lithium mining or the use of sodium-ion batteries, and it will adjust estimates provided Tesla continues to show strong execution. Halter Ferguson's report also stated that, given the difference between its base case and Tesla's recent share price, as well as a high upside return potential of the AI and bot scenario, it still rates Tesla as the highest conviction investment at the moment. What's your thought on the recent report from Halter Ferguson? Let us know in the comments down below. And if you want to know more about what Tesla's been up to in the last few days, go ahead and click on this next video on your screen. See you there.